is the Track B room, the Direct Lending in Focus, and then for the rest of the day we have the ABF in Focus session downstairs where everyone has been this morning. Without further ado, I'll hand it over straight to our panellists for the Understanding the New LP-GP Dialogue session, moderated by Claire Fulton.
Okay. Morning, everyone. Thank you for joining us. I think the last session was running a few minutes late, so people may trickle in over the next few minutes, which is absolutely great. My panelists will introduce themselves in a moment, but my name is Claire Fulton. I'm a partner in our Cayman Islands finance and corporate practice. I'm based here in London, but previously having spent over a decade in our Hong Kong office. And I spend a significant amount of my time in advising our private credit clients, particularly on their direct lending and special situation transactions. Now, I will hand over to the panelists to introduce themselves, and I mean this in the most complimentary of ways, but I think you will all agree, once they've introduced themselves, that they really do bring literally decades of wealth of experience and expertise in this industry. So, Wick, over to you.
Thank you, Claire. Is this on? Okay. So I'm Wick Egan. I've been with Egan Jones, not quite for decades yet. I've been with Egan Jones for about 5 years. And I have to apologize. The session downstairs, they gave out goodies. They gave out these little Fox keychains. Unfortunately, we have our pamphlets from Egan Jones here on the seats. No keychain involved. But maybe if you come back next year, we'll have a nice keychain for you. Egan Jones Ratings was founded in 1995 at the behest of a few institutional investors who wanted to have a different perspective on credit quality. Egan Jones made a number of out-of-consensus calls early in the 2000s and up until the great financial crisis. Egan Jones made calls on Enron, WorldCom, Bear Stearns, Lehman Brothers, GE, GM, a number of others, resulting in Fortune naming Egan Jones, and specifically Egan Jones founder, as the #1 group to warn of the credit crisis. In about 2011 or so, we started to focus on providing credit ratings in the private debt space. Last year, Egan Jones rated about 3,000 different deals across a variety of different structures, and I'd be happy to talk about sort of our general view of methodologies and looking forward to the discussion.
Great, thank you. Andreas?
Thank you, Claire. Good morning, everyone. My name is Andreas Klein. I am responsible for all things private credit at Pictet Asset Management. We are part of a large alternatives platform. It's around $50 billion of management across the globe. We have specific focus on hedge funds, real estate, private credit, and as well as more special situations type of opportunities. Our private credit strategy flagship fund is primarily focused around lower mid-market corporate credit, but we also dabble into some special situations in asset-backed lending as well.
Thanks, Andreas. And Thomas?
Hello, everyone. My name is Thomas Kyriakoudis. I am running our private credit business at LGT Capital Partners. LGT Capital Partners manages about $110 billion of assets across the world, where the biggest focus is on private equity, where we run about 70 billion of the 110. The private credit group is relatively new, so I started that when I joined, we started that about 3.5 years ago. But progress has been good, so we're now managing about a 4 billion multi-strat credit pool, which basically invests in funds and then co-invests alongside those funds in specific assets. The mandate is quite broad, so everything from direct lending, special sits, distressed, structured, asset-backed, and so on. So trying to cover the full spectrum of credit and try and generate alpha by moving between those asset classes.
Thanks, Thomas. Olga?
Good morning. I'm Olga Romanova, and I'm representing ANC Advisors here in London. ANC Advisors provides directors for SPVs, for ManCos, for funds. ANC also provides advisory services on structuring, on liquidations, and a full range of corporate services for funds, including US representation.
Great, thank you. And Francois?
Thank you, Claire. Hi, everyone. So I'm François Touati. I'm running the Secured Finance department within AXA IM Alt. So AXA IM Alt is a 200 billion asset under management invested across alternative credit as well as real estate. The split is about half-half between the two. Inside alternative credit space, we do invest in infra debt, CRE debt, as well as corporate direct lending and some other secured finance as well as specialty finance assets. I'm also responsible for mixing the strategy inside multi-asset type of funds that do invest, for instance, in corporate direct lending and other asset class. And we recently launched one new LTIF2 structure as well as one Luxpart 2 structure to invest into direct lending and other type of asset-backed finance products.
Great, thank you everyone. Okay, so the topic of today's discussion is understanding the new LP-GP dialogue. So I thought it would be helpful before we delve into what that looks like, really to kind of set the scene for everyone here and try and understand a little bit more, I suppose, about what the old dialogue looked like and what the panelists' observations are in terms of market trends and things which have perhaps driven or shifted the dialogue. Thomas, given your, certainly from a panel perspective, relatively unique position of having worked historically as a GP, so sitting on that side of the table and now on the investor side, would you be able to kick off for us?
Yeah, sure. And just for background, before I came to LGT, I wasn't at university. I actually had a job before. And might surprise you. I was at Permira for 13 years, Permira Credits. I was the CIO of that business. So I have a lot of experience from the GP side and from a raising money perspective. And I think if we go back to a decade ago, that experience was very well understood. So the path was you would raise a fund, you'd launch your fund, you'd go to your core LPs, you try and get to a first close, and then you spend a year and a half trying to get to the final close. And usually you'd hit your hard cap quite quickly and you'd stop fundraising and say that's it. And then you'd wait 3 years, go back and then try and raise another fund. So that was kind of the cadence of fundraising back then. Now I would say, it's continuous. That's one big change. So almost no one just exits the market and saying, I'm going to take 3 years off, relaxing until I'm going to go for the next fundraise. So most people are in the market all the time. And there's much more variety of types of funds now. So you have interval funds, you have evergreen funds, you have closed-ended funds. People are kind of working all the time on different fund structures. So there's that complexity. And then I'd say the third point is raising a fund is much more like doing a deal nowadays. So when we, for example, invest in funds, we speak to GPs and we say, okay, what things can you give us that we need? What things can we give you that you need? They generally want primary capital for new funds. We generally want deal flow and opportunities to deploy capital in other ways apart from just investing in funds. And just to conclude, the reason there's that kind of interesting dialogue is because typically what you want to do is get cash in the ground. A fund investment, a primary fund investment, is great because you get a good return, hopefully, if it's a good manager, but it's got some bigger disadvantages. And the key one is that you have the ratio of committed capital to NAV is very large. So if you're an investor, you invest in a fund and you find after 2 years, you might not be well invested. You might only be 10% invested, and it's really very disappointing because you didn't put the dollars to work. And all the dollars you didn't put to work, you have to do something with. So you typically make a subpar return by investing it in cash or treasuries or something else. So for those reasons, that ratio of committed to actual NAV is so crucial in thinking about investing. So those are my comments.
Great, thanks. Francois, do you have some observations on how you've seen the market evolve over the last sort of 5 to 10 years?
Yes, I would echo what Thomas has been saying. Historically, we were dealing with sophisticated investors that have understanding of how the G-curve was playing into the sourcing of private assets in terms of how quickly they can get their money back, close-ended fashion. Today, market have changed. Definitely, the current market landscape is not helping with PE firms not able to get rotating their portfolios as quickly as before. But even through the interval funds, through the more the democratization of the private assets through high net worth, basically, one thing that have changed is definitely the need to be able to educate more, to be with your distributors more, and to make the education work for people to do understand what are the limits of those assets, what are the concepts behind, and how you can be in the market. Definitely, this it has also some benefits, because the benefit is actually you can be continuously sourcing, you can be in the market, even on the asset side, without this ability after 3 years where you need to wait and see whether you are able to raise your next generation of fund. It's more evergreen type of structures, but it has some limits. You have to understand the liquidity question, and we have to educate more and more our clients.
Thank you. It certainly will come on, I think, to talk in more depth about sort of specific, liquidity structures and fund structures. We've heard quite a lot this morning about, as you said, the sort of evolution of the evergreen or the semi-liquid fund. But before we sort of delve into those sort of structural specifics, it's quite clear, I think, there has been a shift in the dialogue, and it sounds certainly to me that there's much more of a sort of partnership going on, and perhaps even the balance of power arguably has sort of shifted away from the GP more towards the investors, who sort of in a more of a sort of powerful position to ask for certain returns or certain strategies to meet their specific needs. I mean, Andreas, your fund is a relative sort of newcomer to the market. From I guess more of a holistic perspective, what would you say now that a modern investor is looking for?
Yeah, I think what you say in terms of the balance of power potentially shifting from GP to LP is certainly true. I think to sort of reemphasize some of the points that my fellow panelists here alluded to, the old guard was very much velocity of capital. Your ability to invest into a fund, have that capital deployed, generate returns was relatively rapid, and we were in relatively benign economic conditions, which meant that the return on investments were generally pretty healthy. Now that fundraising's become a little bit more difficult, and as Francois alluded to there, and Thomas as well, there are new fund structures coming to how to cater to the LP specific needs. It also pushes a lot of the emphasis onto the GP to differentiate themselves in the market. So I think as part of that GP to LP transition, we've also been transitioning from beta to alpha. And it's no longer a beta play anymore, particularly in private credit, where manager dispersion in the last decade would have been relatively narrow in terms of bandwidth. Today, it's very much down to what is the skill set of the underlying team, what is the specific strategy that they're focusing on, and how do they create an edge in that space. So it really comes down, more importantly now, to manager selection and defining the right strategy. And I think, as Thomas was saying, finding a GP partner today is like doing a deal. You're going really deep into the weeds of what they are doing. So, for us, we're not doing anything that's revolutionary in any way, but we're just focusing on segments of the market that we think are a little bit more balanced from a supply-demand perspective. We've seen huge amounts of inflows into private credit, particularly in Europe over the last decade. More recently, we've seen that congregate within certain large managers and large funds. In our opinion, that's created a bit of an imbalance of supply and demand in certain segments of private credit. So we're really just focusing on other segments. For us, that's lower mid-market, special situations, credit opportunities, potentially specialty financing. Those are areas where you can differentiate yourselves as a GP, and also where the supply-demand dynamics are a little bit more balanced and allows you to drive that alpha return.
Great, thanks. I just want to bring Olga in just on the governance piece, because it sounds to me certainly that the average sort of GP board of directors now arguably have to work a little bit harder for their supper, so to speak. I mean, is that reflective of what you're seeing? Are you being asked to provide more advice, or directors, feeling that they're sort of subject to more robust governance structures now?
Definitely. There is definitely a lot more demand for transparency and better governance. And I can also cover it from a slightly different angle as well. Part of what ANC does is we provide outsourced operational due diligence. So we look at the funds from an LP perspective when we work with smaller allocators. My background is from operational due diligence. I worked in this for 20 years. GPs have a choice who they want to share the information with. So for me, when I do represent an allocator or when I work as a director, it's quite important what the GP chooses to disclose. When we look at the funds from ODD perspective, we evaluate the operational aspect of the GP, and that covers everything from how the team is structured, the affiliated companies, the segregation of duties, who is responsible for the operational side. We also look at the counterparties, at the agent bank if they're involved. We look at the legal documents and how those are structured. So transparency is key. The GPs aren't always willing to share this information. So if I do review the GP on behalf of an allocator, that is a major red flag. If we are not able to access the information, if the GP is not willing to share minutes of the valuation committee, if they're not happy to share compliance manual, then we may not be able to make an assessment and provide an opinion. As a director, again, working closely with the GP is essential. If that's the main reason for an independent board member to resign, if the GP is not willing to provide information on the transactions, or if they're not willing to disclose in advance how they're proceeding or discuss key aspects, that's not going to be a working relationship for us. We have a policy of meeting with the managers or GPs on a monthly basis, even apart from the board meetings. If they're not happy to do that, we're not going to be appointed.
Yeah, well, that makes sense. So in addition to that, I suppose, the desire for greater transparency and sort of alignment between the GP and investor, I mean, Wick, in your industry, I mean, you must have quite an interesting perspective on what various GPs are doing to try and sort of differentiate themselves in the market. I mean, interestingly, this morning, I think it was two of the gentlemen from Ares were talking about something they're doing, which is partnering with a couple of various charities, so that a certain percentage of returns are going into a charitable foundation. So what sort of things are you seeing from your perspective that are really setting apart certain GPs from others?
So I can't speak to that specific example that you're referring to, but I'd say what Andreas had mentioned is exactly right. Maybe I can provide a little bit of a historical perspective. This industry was founded to provide funding first and foremost to corporates who couldn't get bank lending easily. And they couldn't get bank lending easily because of the capital requirement restrictions in some cases on banks. And what's happened over time is the market has evolved to the point where there are structures that are, as you're alluding to, more attractive for LPs. Egan-Jones did one of the first feeder fund ratings as far back as 2012, and that has been the structure du jour because it typically means that it's more attractive for the LP from a capital treatment perspective. You have the benefit of diversification, but you don't necessarily have the costs that are associated with a CLO. So it can be thought of as, in many ways, as a light CLO. When it comes to, as we see it at Egan-Jones, what LPs want, they want a variety of things, and Andreas referenced this tangentially. They certainly want to have attractive risk-adjusted returns. They want to minimize their tax burden. They want to have forward flow, as we're talking about, absolutely. And they want to be able to tell a good story. They want to have differentiation from the current assets or the current GPs on their books. And it's in that area which I think we're going to see quite a lot of focus over the next 5 years. As this industry becomes more popular, it's going to be more difficult for smaller GPs to, let's say, sell themselves based solely upon the asset class that they're exposed to, which historically that was an important differentiation point. But rather the point of differentiation is going to be on maybe there's a sub-asset class that they can expose them to, not just private credit as a whole, and also perhaps their origination strategy is going to be more attractive. What you'd mentioned about the charitable allocation, that certainly seems interesting. At Egan-Jones, we just haven't seen a lot of that.
What about sort of ESG points or sort of considerations? Is that coming in or showing itself to be a kind of alternative strategy that GPs are advertising or playing on?
So what I can say is at Egan-Jones, we've rated a number of assets which have an ESG aspect to them. For example, in the United States, there's a structure called PACE, which is Property Assessed Clean Energy. It's a way of financing green investments on real estate assets, and there's CPACE, which is just the commercial version of that. That has been popular, and we expect that to continue to be, perhaps with some of the changing regulations that might affect that. Currently, those standards are administered at a state level, so the federal regulatory environment might not have a direct impact on it. When it comes to Egan-Jones implementing ESG factors into our rating criteria, we made the strategic decision not to include ESG factors in our criteria because those factors tend to change over time. If the focus is on resilience versus prevention, Egan-Jones simply has chosen not to address that.
Okay. It's very helpful, thanks. So I think let's just delve a bit more into some of the sort of very specific or technical sort of liquidity and fund structures that you're seeing used in the market to, as we say, for various funds to really try and differentiate themselves from their competitors. Certainly, in this morning's sort of sessions, the concept of evergreen funds or semi-liquid funds were mentioned a number of times, and my understanding of these is they're attractive in terms of this so-called sort of democratization of private credit. The ticket size is the barrier to entry, is a lot lower, so you're kind of able to attract this broader group of potential investors, which I think we're currently seeing. But I mean, Thomas, could you just talk a little bit to what you've seen or how you've seen those types of structures used in the market?
Yeah, so I think there's two key aspects to evergreen funds, or however we want to call them. One is liquidity on the way in, and one is liquidity on the way out. And typically, in our experience, institutional investors care more about the former, and let's say wealth or mass market cares more about the latter. So if I'm an institution, my focus is I would like to diligence a portfolio of assets where I can look at the assets, understand them, go through them, what am I getting into, versus a closed-ended fund. If you're in the first close of a closed-ended fund, you're literally investing in a PowerPoint and an idea and your belief in the track record of the manager, but no actual assets. So I think that's one of the key kind of benefits, if you like, of the evergreen vehicle for an institutional investor, is that ability to diligence the actual portfolio you're going into and get dollars to work. As I mentioned in my first answer, that ratio between commitment and NAV is so crucial for most institutional investors. We now don't really look so much on IRRs. I actually don't think an IRR is a particularly good way to measure performance for a credit manager. We would look at annual return on dollars committed is how we would think about returns. Because what we want is that if we commit X amount of dollars to your fund, how many dollars will you give us in a year's time or 2 years' time or 3 years' time? So that's, for us, the key measure is return on dollars committed versus an IRR number, which, is, I think the famous quote is you can't eat IRR. So, that's on the way in. And then on the way out, I think that's particularly focused for, like, let's say, the wealth channel. People are very focused on the ability to get out, to get liquidity, to reallocate to different strategies. That's the focus, I'd say, for wealth. And that's a lot harder to deliver, I would say. So generally, people find generating true liquidity out of a fund is difficult. And there's probably only two kind of ways you can do it. One is investing in liquid assets. So if you only invest in illiquid assets, you won't be able to generate liquidity when you want to exit. You need to allocate some liquid, some illiquid, and use that to generate cash. Or the second one is having some kind of gates of your fund where you restrict liquidity in some way. We've seen people, for example, you go into what they call a slow pay tranche. So you say, I want to exit, and then you'll just go into a roll-off, and as those assets redeem, you get your cash. But it's not really what I call a liquid solution. So that's some of the stuff we've seen.
Andreas, are you seeing any other particular structures that are being used to attract investors?
Well, I guess I'm going to have to say this. I concur with everything that Thomas said. I think there's no one size fits all.
Yeah.
And again, as Thomas was alluding to, institutional investors versus wealth investors have different requirements.
Yeah.
I think what is helpful is the whole industry's moving slowly in that direction. I mean, we've had evergreen funds for a long time. We just called them segregated mandates earlier. But now we're pooling those commitments together into what we call evergreen funds. Having said that, there's been helpful developments on the regulatory standpoint as well. So when we're looking at more the retail end of the investor spectrum or the wealth end of the spectrum, the LTAF, LTIF directives that are present in the UK and in Luxembourg have generated a framework that allows managers and GPs to operate in with liquidity elements embedded into some of that guidance and directive. I think to maybe some free advertising for Wick and Olga here, the whole concept of transparency is going to become very important when you have a liquid fund or semi-liquid fund. And how do you value those assets? How do you rate those assets? What is the transparency in terms of getting the NAV correct? Yeah. All these things are things that I think many GPs have to think about getting right. It is very much a move away from the typical closed-ended structure that we had, where valuations were, really an art as opposed to a science. Whereas now we need to move into a domain where you're actually valuing those assets on entry and exit in a fair and transparent kind of way. So there's a lot of effort that needs to be made on the GP front to meet those needs.
Do you agree with that, Olga? I presume that if you're working on these more sort of frequent exits, that the board are under continued sort of scrutiny and pressure to deliver and be as transparent as possible.
Absolutely. Transparency is the main ingredient to building trust, and this industry is still very much based on trust in terms of allocations. So for me, both as a director and working on the operational due diligence for LPs, transparency is key. If, again, as I mentioned before, if the GP is not disclosing the details that are required, then it's not going to be approved or accepted as an appointment. And fraud and misappropriation is still my main concern when I look at the funds on behalf of LPs. So whenever I see the manager that's using multiple SPVs to host different assets, I do need to have full transparency to understand how the cash flow passes through all of the different entities, who has oversight and reconciling items and so on. I have seen a case in my career, I wasn't involved, but I've seen it quite close when a misappropriation did take place, and it was somebody who was quite respectable on the first site, who was siphoning off funds through an SPV, and the GP made the investors whole, but nonetheless that was still reputational damage, and we want to avoid this as much as possible. To avoid this, we need to have full transparency. The GP has to be cooperative and disclose all the processes and procedures that we need to evaluate.
Thanks. Okay, so if we just linked, but moving forward, there's obviously the economic climate is such there's been a lot of conversation around deploying capital and exit strategies and additional return strategies, etc. I mean, Francois, what are you seeing to that in the market? Is it a new dialogue, so to speak, based on some of the structures and products we've just been discussing?
I think it's also linked to the assets. Some things are actually changing in the market.
Yeah.
If you take a look, for instance, at how allocations are made today, it's quite often that a PE sponsor would ask a GP to allocate some other people and not to have one single unique investor as a lender group in front of him. This enables some sort of potential liquidity in the future ahead. That's not the case today, for sure, but this could offer some means. Valuations as well, the fact that indices are being put together more and more, data is coming out of our markets, basically, helping into framing what are the points around what should be the pinpoint in terms of key inputs into valuations as well, are also of importance in addition to the intrinsic aspects of a specific deal. But the landscape is building. On the liability side, also, some stuff are building. We know NAV for PE funds, but actually NAV lines for credit funds are also in the makings. So this also, although they are not perfect and have their own risks, can permit to think of tomorrow some other work around liquidity. But first and foremost, definitely education. People do have to understand we are still in illiquid markets, whatever I mentioned, and that this gives you, you have a cash flowing asset with a maturity, but besides those factors, the ability to have like a 3-year average life portfolio can just be flooded from time to time, and we need to make sure that in those specific times, the portfolio constructions in terms of vintages of assets, in terms of risk driver of individual assets, are the right one to make the mix to provide the liquidity that was on day one labeled for investors.
Promised, yeah. And who's providing that education, as you say, do you think? Is that...
That's the work of the GP, basically.
Yeah.
If we don't do it, nobody will do it for us. I mean, Egan Jones or other rating agency can do good work in terms also of promoting concepts of what can be right or wrong into the asset class. It is what a rating is made for. But GPs have to make their own work into getting through the journey with investors and explaining them where are the pitfalls of this. Because actually, Andreas was right, regulators have given their take into what it should be. UK LTAF is different from European LTIF. For instance, LTIF, there was version 1 back in 2015, there's version 2 nowadays. So it just means people are reacting to what are basically the concepts of liquidity, valuation, and how are fair treatment of investors. But at the same point in time, our markets are evolving as well, and we need to take that into consideration.
Yeah. Wait, would you agree with that? The rating agency have a role to play in that sort of world of education?
I certainly would hope so. Yeah, and I think that these are all good points, Francois. Thank you. I think credit rating agencies have to do a good job of educating actually investors as well as GPs on how our methodologies work broadly and how we consider credit risk. I think some humility is certainly warranted because there are certain factors that investors can control and there are certain factors that are more difficult to control. McKinsey had a very interesting slide showing earlier today that the difference in terms of return within the private credit market isn't nearly as much as what you might expect in other markets. And of course, where there have been relatively few defaults, some people referred to, particularly around the pandemic period, as the golden age of private credit because you had high yields and relatively few defaults. You would expect actually there not to be a significant difference between the highest and lowest performers. But of course, it's when you have a larger credit cycle downturn when you'd expect that spread to increase. And in terms of what can be controlled by the GP, well, the structure that they're providing to the LP can be controlled. Certainly, they have to think about, well, what is the capital treatment that is being experienced by my LP? A rating certainly can often help with that, but also if you have the proper structure, which will enable a better rating, and a feeder fund has been very popular, I would say that typically is the right approach.
Great.
Just maybe to cut in there. I mean, I agree with you. If you look at IRRs, the delta between the best and the worst is small.
Yeah.
But if you look at the measure I mentioned, which is return on committed capital, there's a massive delta, right? So we've had GPs that have, after 3 years, have only been 20% drawn, right? And then some GPs are 100% drawn after 3 years. Some provide lots of co-investment opportunities on a free, no carry basis, and some provide none. So if you actually look at those, and that's how we chart it. So we look at the GPs and says, what's your return on, your dollar return on committed capital? You can see a huge dispersion versus the very tight dispersion of IRR.
That's helpful, thanks. I'm conscious we only have a few more minutes left, so I'd just like to ask each of you what essentially you think is going to be the biggest point of interest or the greatest sort of area to watch, just in terms of either alignment or a mismatch between the LP and GP dialogue going forward for the next 12 months. Perhaps we'll start with Francoise Wick. I'm conscious that you predicted the GFC, so you presumably are holding a crystal ball. So we'll wait for your version or your answer at the end. But Francois, would you like to kick us off?
I think I would echo also what we heard this morning. You have different type of investors looking for different stuff.
Yeah.
You have sophisticated investors that knows our market by heart, that knows the corporate direct lending by heart, and so they now have a mapping of all GPs, what GPs are doing. They are in due diligencing them very, very often, and so they are intimate with the asset class, but not only with the asset class, with the teams that are investing into this asset class. So I think for them, a lot has been discussed already, because what they look for is the right assets, the right return, and the deployment of capital that makes sense for them, with valuations that make sense. If you turn to the newcomers in terms of investors into the asset class, those guys need to be educated. There's a lot more to do here. Second, they are looking for some sort of liquidity, so you have to have the right belt and whistles to make that happen. And lastly, what we see more and more is people not only looking to invest into corporate direct lending, but to invest more broadly into private assets. As a result of that, there's a question mark into how you make that compelling for them, and how you bundle that into a format that makes the whole private assets available to them. I think we've seen a lot of headlines these days around the largest manager doing so, and there's more to do here. And I think over the next 18 months, things will change and will continue to change on that aspect.
Great, thank you. Olga?
I would only make a very brief point. I would like to see a lot more alignment between GPs and smaller allocators. It's easy enough for the GP to provide all the information to a larger LP, but I want small LPs to be treated as equally. So.
Good point. Yep. Thomas?
I would just say, I think as one of my first comments, I think the game has changed in terms of the GPs that will be successful are the ones that can engage in a really sophisticated way with LPs, through things like co-investment or deal opportunities, or just relationships, and explaining what they're doing. I think we still have some GPs that say, "Oh, it's a black box. We won't tell you what's in here. It's just you just have to invest and wait for the return." I just think that's a very old-fashioned perspective, and that would just go completely out of fashion. So I think the most smart GPs are thinking, be transparent, be open, work in partnership across multiple areas. That's the route to success, in my opinion.
Great, thank you. Andreas?
I'll take a more GP-centric perspective on this. I mean, I think, this whole discussion around new fund structures, LP-GP dynamics has evolved from the fact that fundraising has been difficult. We're looking to tap into new asset classes. DPI has been relatively low, and the velocity of capital has been slow. But I think fundamentally, for us at least, it's just focus on the basics. So for us, it's about the investment performance, generating that alpha. It's down to the quality of the team, the ability to generate proprietary deal flow. So find transactions where we can differentiate ourselves and where we can generate a bit of an edge. And as long as we can deliver performance as a GP, the nuances around, are we providing monthly liquidity, quarterly liquidity in our LTIF or not? I think that's on the fringe, but to us, it's back to basics and demonstrating GP manager performance.
Great. Wick?
Yeah, at Egan-Jones, many of our smaller GP customers have either consolidated or become much larger, and our large customers have become even larger. I expect that you'll continue to see consolidation among GPs, and among those smaller GPs, I completely agree with Andreas. That is, you'll see more specialization in terms of the sub-asset class that they might be focusing on. They might have unique origination tactics, and from the LP's perspective, they're going to continue to want to have a machine that generates flow for them, even if there is a credit cycle that turns down.
Yeah. Thank you very much. It's been an incredibly interesting discussion. Could you please join me in thanking the panelists for this morning's conversation?
Thank you.
Thank you very much to Claire and the full panel for the Understanding the New LP-GP Dialogue session. I'd now like to dive straight into our next session, so I would like to invite our next set of panelists, which will be the Blurred Lines, the Democratization of Private Credit. We'll just get the stage set and we'll be underway in just a moment. Thank you.